Booyah! Listen up, folks. Before we had all this high-speed internet and fancy trading apps on our phones, there were giants walking Wall Street, titans. And one of the biggest, one of the smartest guys in the room was a man named Marty Zweig. You might know him from that time he called the 1987 crash. I'm talking about Black Monday, people. He went on TV the Friday before the market went splat and told everyone to get out. He was a market wizard, a genius who developed a system. He didn't just guess, he had rules. A set of battle-tested, money-making, wealth-building rules that are just as powerful today on September 21st, 2025 as they were back then. So, who was this guy? Marty wasn't some loudmouth screaming on TV like, well, you know who. He was a numbers guy, a PhD who crunched data like it was going out of style. He looked at everything: interest rates, market momentum, investor sentiment, you name it. He built a fortress of indicators to tell him when to be aggressive and when to run for the hills. What I love, what you should love, is that he wasn't about ego. He was about what the market was actually doing. He listened to the tape, he respected the trend, and most importantly, he had a discipline that was rock solid. These rules are your roadmap through the treacherous jungle of Wall Street. Alright, let's dive right in with the big one, the cornerstone of the whole Zweig temple. Rule number 1, the trend is your friend. This is so simple, yet so many people get it wrong. It means you don't fight the market's momentum. If the overall market is chugging higher like a freight train, you should be on that train buying stocks. If the market is falling off a cliff, you don't try to be a hero and catch the falling knife. You step aside, you wait, you preserve your capital. Think of it like this: you're planning a beach party. You check the weather forecast and it says there's a 90% chance of a hurricane. Do you still send out the invitations and buy the hot dogs? No! You cancel the party. You wait for a sunny day. The stock market has its own weather system. A bull market is a long stretch of sunny days where stock prices are generally rising. A bear market is a hurricane where prices are falling. Zweig's rule is simple: throw your party when it's sunny. Don't try to have a picnic in a hurricane. Let's talk about a real-world example. Remember the tech boom of the late 2010s? Apple, Amazon, Nvidia? The trend was screamingly obvious. It was pointed straight up. Investors who followed Zweig's rule and rode that trend made a fortune. They didn't stand on the sidelines saying, oh, it's gone up too much. They stayed with the winners. So how do you spot the trend? Zweig used moving averages. Look at a chart. Is it going from bottom left to top right? That's an uptrend, baby. Let's get into the second commandment from the Book of Marty. This is a big one. Listen up. Rule number 2. Don't fight the Fed. Don't fight the tape. The Fed, the Federal Reserve, controls interest rates. Lowering rates equals pumping money into the system. They're basically handing out free juice to get the party started. That's good for stocks. Raising rates equals taking the punch bowl away. That's bad for stocks. It's that simple. Fighting the Fed is like arm wrestling a gorilla. You are going to lose. The tape equals market price and volume action. It's the heartbeat of the market. It tells you what is actually happening, not what some analyst thinks should be happening. If a stock keeps going up day after day on heavy volume, the tape is strong. If it's sinking on heavy volume, the tape is weak. Don't argue with it. Let me give you a scenario. It's 2022. Inflation is raging, and the Fed starts talking tough. They announce they are going to raise interest rates, and raise them fast. What does Zweig's rule tell you? It tells you to be careful. The gorilla is waking up. The Fed is no longer your friend. And what happened? The market had a terrible year. Here's another one on the tape. Imagine a little biotech company announces a promising new drug. The story sounds amazing. You want to buy it. But you look at the chart, and the stock price has been drifting down for 6 months. What is the tape telling you? It's telling you that the big money, the smart money, isn't buying the story. They're selling. Following Zweig means you trust the price action and stay away. The tape knows all. Don't ever forget that. Ever. Alright, next up is a rule that will save you a world of hurt. It's about human psychology, about the madness of crowds. Rule number 3, beware of extremes. This applies to everything: market sentiment, valuation, price movements. When things get too crazy in one direction, a reversal is almost always just around the corner. When every single person you know is a stock market genius quitting their job to day trade crypto from their mom's basement, that's an extreme. That's a blaring sell signal. It's the top. Magazine cover. The New Paradigm magazine cover, $1 million Bitcoin. That's the time to be scared, not greedy. Conversely, when things get too pessimistic, it's often a screaming buy opportunity. Think about the depths of a market crash. March 2009, March 2020. The news is filled with doom and gloom. Headline: The end of capitalism. Headline, Dow 5000. Everyone is convinced the world is ending. Your neighbor sold all his stocks, buying canned goods, buying gold bars. That is an extreme of pessimism. That is the point of maximum fear. And as Warren Buffett says, it's the time to be greedy when others are fearful. Zweig's indicators were built to spot these moments of extreme sentiment. Dot-com bubble, 1999, early 2000. It was the definition of extreme. Companies with no profits, no revenue, no real product were going public, and seeing stock prices double in a day, seeing stock prices triple in a day. Cab drivers were giving you stock tips. It was a mania, extreme euphoria. Zweig's rules would have told you to get the heck out of Dodge. When the bubble burst, those who ignored extremes were wiped out. They held on, praying for a comeback while their portfolios evaporated. Now let's flip it. Financial crisis, late 2008. Banks were failing. People thought the system would collapse. Sentiment as bad as it gets. You could buy rock-solid companies for pennies on the dollar. It was terrifying. An extreme of pessimism. Investors who bought when there was blood in the streets were rewarded with massive gains over the next decade. Zweig's lesson? Be a contrarian at the extremes. This next rule is the secret sauce for turning good returns into great ones. It sounds simple, but it's honestly one of the hardest things for investors to do emotionally. Rule number 4 is actually a combination of two famous trading adages that Zweig lived by. Let your profits run. Cut your losses short. This is the key to successful risk management. Most amateur investors do the exact opposite. They get a small, quick profit in a good stock, and they sell it immediately, afraid of losing their little gain. Then they take a loss on a bad stock and hold on to it forever, hoping and praying it will come back to even. This is a recipe for disaster. Let's break down, let your profits run. When you find a winning stock in a strong uptrend, you don't sell it just because you have a 20% gain. You ride that winner. The biggest money is made in the big multi-year trends. Think about buying a stock like Amazon in 2015. If you sold it after a 30% gain, you would have felt smart for a week. But you would have missed out on a massive, life-changing run that went on for years. Now for the other side of the coin, cut your losses short. This is where discipline is everything. Zweig advocated for using stop losses. A stop loss is simply a predetermined price at which you will sell a stock if it goes against you. For example, you might decide to sell any stock that drops 10% from your purchase price, no questions asked. This takes the emotion out of the decision. You're not hoping or praying anymore. You have a plan. The stock hits your stop, it's gone. Sell it and move on. This prevents a small, manageable loss from turning into a catastrophic, portfolio-crushing disaster. Imagine you buy 2 stocks. The amateur investor sells the winner for small profit and holds the loser hoping for recovery. The Zweig investor does the opposite. By cutting the loser and holding the winner, the Zweig investor makes a fortune while the amateur churns their account and goes nowhere. It's all about maximizing your winners and minimizing your losers. It's math. We touched on this with the beware of extremes rule, but Zweig made this central to his system. Rule number 5, pay attention to sentiment. Sentiment = the mood of the market. Is the crowd bullish, optimistic, or bearish, pessimistic? Zweig was a master at measuring this. He knew that when too many people were on the same side of the boat, it was about to tip. He didn't care about opinions, he cared about data. He used surveys like Investors Intelligence Advisor's sentiment. Think of it like a popularity contest. When a stock is the most popular kid, everyone loves it. That's usually right before it embarrasses itself. Simple analogy, a new pizza place opens. First week, a few adventurous foodies go, they love it. That's smart money. Next month, word gets out it's crowded every night. Trend followers. By month 3, 2-hour waits. It's on the cover of the local magazine. People who don't even like pizza going just to be seen there. That is extreme bullish sentiment. Pizza probably isn't as good anymore, service is slow, it's way too crowded. Time to find the next new place, don't wait in line. Zweig also watched the put-call ratio. Puts = bets the market will go down. Calls = bets the market will go up. Tons buying puts = super bearish and scared. Often a contrarian buy signal. Everyone loading calls feeling invincible = potential sell signal. You don't need a PhD, just watch the mood. When your brother-in-law who knows nothing about stocks starts raving about a can't-miss tech stock, that's a sentiment indicator. Be wary. So, there you have it. We've walked through some of the biggest, most powerful rules from the master, Marty Zweig. These aren't just a random collection of folksy sayings. They are an interconnected system. a machine for processing market information, making disciplined, unemotional decisions. They are your shield and your sword in the battle for financial freedom. This is the playbook. Think of it as a checklist before you make any investment. Is the overall market trend up? Check. Is the Fed being accommodating with interest rates? Check. Is the stock itself in an uptrend? Is the tape positive? Check. Is sentiment neutral or bearish, not wildly euphoric? Check. If you can answer yes to these questions, you have a green light. If you get a lot of no's, you hit the brakes. It's that simple. This process forces you to be objective. It stops you from falling in love with a story. It forces you to respect the reality of the market. Following these rules matters more today than ever. Information overload, non-stop noise, social media hype. It's easy to get caught up in the latest fad, the meme stock of the week, or the panic of the day. Zweig's rules are your anchor in this storm. They filter out the noise and focus on what matters: price, momentum, monetary policy, sentiment. They give you the confidence to buy when others are fearful, the discipline to sell when others are greedy. They are the key to not just surviving but thriving. So I'm begging you, print these rules out, tape them to your computer, memorize them, make them your mantra. This isn't about being a genius, it's about being disciplined. Marty Zweig gave us the map. He showed us the way to navigate the market's treacherous waters and reach the shores of wealth. Now go out there and make some money. Booyah!